Right. So we will take this standard and we will try to understand the relevant paragraph and we will try to link that to our conceptual diagram, right? Fine. So I have highlighted this relevant paragraph for us to save the time. Why? Because entire standard I can't read it with you. Why? Because there are many pages, right? I have done that homework for you. So now if you are not highlighted your standard book with me, you can do it, and at the same time you can apply, you can insert paragraph numbers as well, right? Fine. Quickly. Paragraph 5 explain you control. Para 5, right? Control. An investor, regardless of the nature of the involvement with an entity, investee shall determine whether it's a parent by assessing whether it's control the investee. Very important word is what? Control the investee, right? Paragraph 6, only important paragraph I will take, right? An investor controls an investee when it is exposed or has rights to variable return from its involvement with the investee and has the ability to affect those returns through its power over the investee. That is control, right? Thus, investor control an investee if the investee has all the followings. If you are satisfied with one requirement, you can't say you have controlling power. All the following. Paragraph 7, you can directly insert that. Control explained in paragraph 7. Para 7, right? Para 7, right? Paragraph 7. So you can take this screen later. Why? Because it is very difficult for us to video both together, right? We'll go through standard first and I will show you again the paragraph numbers, right? Fine. So here all, what are they? Power over the investee, I explain you power, exposure, rights to variable return, ability to use the power over the investee to affect the amounts of investee's return. All these things, power explained in paragraph 10 to 14, variable return explained in paragraph 15 to 16, and ability to use power over investee to affect investors' return explained in paragraph 17 to 18. So you have to go back to para 10 to 14, 15 to 16, 17 to 18, basically from 10 to 18 to understand this control in detail, right? All these things also I have highlighted for the time being. We'll go through the standard, right? Power, so right? Power explain kala tiyanga paragraph 10 to 11 here. Very simple, right? 10 to 14. Paragraph 4 කියලා තියෙන power කියන එකට. Right, we'll see what they have interpreted. Power. Paragraph 10 explain power. Para 10 to 14. Right? 10 to 14. Paragraph 10 to 14. An investee has power over investor has power over investee when the investor has existing rights that gives the current ability to direct relevant activities. Ability to direct relevant activities, right? Here, if you read paragraph 11, power arises from rights, right? Power කියන්නේ ඔයාගේ ඇඟේ තියෙන හයිය නෙමෙයි, right? Power arises from rights. Sometimes assessing power is straightforward. When you assess power, it's straightforward, such as when power over investee is obtained directly and solely from voting rights. That's why in my paragraph I have explained you power means voting rights, right? Paragraph 11 also you have to insert. Para 11 explain what rights, right? Voting right. Underline this word, right? Then variable return, right? So paragraph 11 read, yes. Yeah, that is 14, right? And return. Return explain in paragraph 15 to 16. An investor is exposed or has rights to variable return from the involvement with the investee when investor return from its involvement have the potential to vary as the result of investee's performance. I explain you power return, the relevant here the intention is only to show you the relevant paragraph from the standard. Thereafter you can insert those things, right? Therefore I am not trying to discuss these things in detail. Already I have explained in detail. Link between power and the return I told you, that is paragraph 17 and 18. I have not highlighted why. All these things you can see below, right? Fine. Go to B56. Straight away I will take you to that section. B56. Exposure rights to variable returns. Second thing is that variable return, right? Exposure or rights to variable return. B56. Read it. B56. Variable returns are the returns that not fixed, I told you, not fixed. Go and see in your summary. Have the potential vary as a result of performance of the investee, right? B56, I explain you. And here you can see the examples, right? These are the examples. Dividends, remuneration from service in an investee's asset and liabilities, return that not are available to other investment holders, that's fine. B56 and B57 explain that properly. And go to B60, right? Link between power and the return. B60. Link between power and the return. The decision maker shall consider overall relationship between itself, investees being managed and other parties involved with this investee. In particular, all factors below determining whether it's an agent, right? Look at straight away D. Decision makers exposure to variable return from interest that hold the investee. So that is explain the relationship, right? So B60 explain that. Thereafter, I wanted to explain you what? Go to B11 as well. Whether make summary you should have, right? You should have summary in your hand, otherwise you can't understand what I am doing here, right? Already I have summarized that. Relevant activities. What do you mean by relevant activities? I told you. Relevant activities means for any investee, a range of operating and financial activities significantly affect their return. What are they? Selling and purchase of goods and services, managing financial assets during their lifetime, selecting, acquiring, disposal of assets or assets, researching and development new product or processes, determining the funding structure or obtaining funding. So these are the relevant activities. Relevant activities explained in B11. Relevant activities B11. Right? B11. Right? Fine. Then go to para 19. Again I am repeating, if you don't have that summary, what I am doing here is a magical thing for you, right? You will not understand. Therefore, you should have that summary. Accounting requirement. A parent shall prepare consolidated financial statement using uniform accounting policies. Underline the word uniform accounting policy, which means subsidiary and parent company both they should follow the same set of accounting policies, right? For like transactions and other events on similar circumstances, right? Fine. Para 19, accounting requirement, para 19, as well as go and see B86. right? B86, accounting requirement, consolidation procedures, right? B86. B86. B86 explain you consolidated financial statement. How do you prepare that? Combine like items of asset, liabilities, equity, expenses, income, offset carrying amount of parents investee in each subsidiary, eliminate in full intergroup assets and liabilities, equity, income and expenses and cash flows, right? So those are 3 steps of consolidation procedures, right? Fine. Then go to B92. We are talking about what in 92? Reporting date. I told you this is also little important, not little, much more important. The financial statement of the parent and subsidiary used in the preparation of consolidated financial statement shall have the same day reporting date. Shall have the same reporting date. Underline the word shall have the same reporting date, right? When the end of reporting period of the parent is different, when the end of the reporting period of the parent is different from the subsidiary prepares for the consolidation purpose additional financial state information as of the same date as financial statements of the parents to enable parents to consolidate financial information of the subsidiary unless it is impracticable to do so. If it is practical, you have to prepare another set of financial statement. Let's say your parent prepare financial statement from 1st April 2018 to 19, let's say April to March, but subsidiary prepare January to December. So then subsidiary should prepare for consolidation purpose from April to December. For 9 months you have to prepare, right? If it is impracticable to do so, eka practical නැත්තම්, right? The parent shall consolidate the financial information of the subsidiary using most recent financial statement of the subsidiary adjusted for the effect of significant transaction or event occurred between the date of those financial statement and the date of consolidated financial statement. In any case, the difference between date of the subsidiary's financial statement and that consolidated financial statement shall be no more than 3 months. Then and the length of the period and the difference between the dates of the financial statement shall be the same date from the period to period, right? Fine. If it is impracticable to do so, if it is impracticable to prepare another set of financial statement for the consolidation purpose, you can take most, underline the word, most recent financial statement of the subsidiary adjusted for the effect of the significant transaction or events occurred between the date of those financial statement and the consolidated financial statement date, right? But it should be, the gap should be more than, shall not be no more than 3 months. That also you have to understand, right? Fine. That is reporting date. Reporting date was there in the summary diagram. You can insert paragraph. Paragraph 92 and 90, sorry, B 92 and B93. B93, right? B93. So then you can go and discuss B97. Loss of control. A parent might lose the control of a subsidiary in 2 or more arrangement transactions. However, sometimes circumstances indicate that the multiple arrangements should be accounted as single transactions, right? There are many transactions, during many transactions you may lose the control, but you have to combine those things and you have to look at in a single point of single transaction. In determining whether to account for arrangement as a single transaction, a parent shall consider all the terms and conditions of the arrangement and their economic effects. One or more of the following indicate that the parent should account for multiple arrangement as single transaction. That's fine. You can read it for, right? B97. B97, right? Then, if parent lose the control, it shall be B98 also important. B98 98. Explain what? You have to derecognize. It shall derecognize the assets and liabilities of the subsidiary at their carrying amount at the date of control is lost. The carrying amount of any non-controlling interest in the former subsidiary at the date when control is lost, you have to derecognize, right? Fine. Thereafter, last one, minor interest. You have to go to paragraph 22. Para 22. A parent shall present non-controlling interest in the consolidated financial statement within the equity separately from the equity of the ownership of the parent, right? In your balance sheet, you have to separately, you have to show the equity interest of the owner from owners of the parent. Changes in the parent ownership interest in the subsidiary that do not result in the parent losing control of the subsidiary are equity transactions. Fine. Para 22. Right? We'll see with this in detail with the calculation, right? Para 22. And go to appendix and read the definition of console. That is what I told you, I took it from straight away from what? The standard. Consolidated financial statement, right? Appendix. Consolidated financial statement, the financial statements of a group in which the asset, liabilities, equity, income and expenses and cash flows of the parent and its subsidiaries are presented as, underline the word, single economic entity, single economic entity, right? Single economic entity. This is much more important word for me, right? Fine, done. So we have done SLFRS 10 standard. Now by using those consolidation procedures, I told you I will discuss simple exam question. Before that, we will take the screen and I will show you the paragraph. Suraj. Here, in the same visualization, definition is there in appendix, right? Control explained in paragraph 7, para 10 to 14 power, B56 exposure or rights to variable return, B6 the link between power and the return. And rights and variable return explained in para 11 and B11, right? Fine. And consolidation procedure paragraph 19 and B86. Reporting date B92, B93 and loss of control B97 and B98 and non-controlling interest paragraph 22. So this is the entire summary of SLFRS 10. So with this I will explain you a basic consolidated question. This is not, don't expect much more complex calculation here. Why? We have very limited time. With this very limited time, I am trying to explain you the logic behind each and every calculation when it comes to consolidated financial, when you prepare consolidated financial statement. Understand the logic. This question is to explain you the logic behind each and every calculations, which means goodwill, minor interest, post-acquisition share of profit, how you distribute and how do you amalgamate asset liabilities and how do you present minor interest or non-controlling interest separately in your financial statement. For that purpose, I will take the simple question that will not take much more time. Those who are not logically understand this, the way of preparing consolidation financial statement or the consolidation procedures, this is a good opportunity for you to understand that. Don't try to remember the steps. Most of you are remembering the steps of consolidation procedures. So, goodwill at the end of the day, so you might not be able to identify if there is any different information in the question to deal with those questions. You don't understand it. Why? You have remember things in your head, right? But if you have logic in your mind, so then whatever the thing there in the exam question, you can handle very easily, right? Keep that also in your mind. With that, we will do this question, right? Fine. First of all, before that, read this question. Right, read this question. Very simple question, very simple basic question. So take few minutes and read it. So then we will work together. So when you compare with past papers, this is not a that much complex question, right? Very simple question. So you can't, if you can't read it. The following are the draft statement of financial position of P company and Srima, we call it as S company, as at 30th September 2015. P and S balance sheet you have. Assets, non-current assets you have, property, plant and equipment, investments you have. Amounts are not relevant for us. Why? Straight away we can use when we prepare consolidated financial statements. And current assets and total assets you have. Equity and liabilities you have. Equity shares, retained earning and revaluation surplus, right? A very basic balance sheet. Then you have non-current liabilities, deferred consideration and current liabilities you have, right? Total equity and liabilities you have. So this is very simple balance sheet again, right? Fine. So these informations also you have to deal with this information, right? Common information you have. On the 1st October 2014, P acquired 80% of the share capital of Srima company. At this date, the retained earning of Srima company were 34 million and the revaluation surplus stood at 4 million. P company paid an initial cash amount of rupees 92 million and agreed to pay the owners of Srima company further 28 millions on 1st October 2006. Fine. The accountant has recorded the full amount of both element of the consideration in investments. So deferred consideration as well as the purchase consideration which is paid in cash, both together you have included in where? In your balance sheet, right? Right, fine. So then the accountant has recorded, fine, we read it, and the appropriate discount factor 0.857. On 1st October 2014, the fair value of Srima company net assets were equal to their carrying amount. Right? Srima net asset equal to their carrying amount. Very important statement. Net asset equal to their carrying amount with the expectation of with the exception of some inventory which had cost 3 million but had a fair value of $3.6 million. On 30th September 2015, 10% of these goods remained in the investors of Srima company. During the year, P company sold goods totaling $8 million to Srima company at a gross profit margin of 25%. At 30th September 2015, Srima company still held $1 million of these goods in inventory. Party company normal margin to third party customers is 45%. The parity group uses the fair value method to value non-controlling interest. You must use it, right? At acquisition, the non-controlling interest was valued at 15 million. Very important, 15 million. Why? Here, fair value estimate on the date of acquisition, net asset on that day equal to carrying amount, right? Net asset equal to carrying amount. Here, at acquisition date, non-controlling interest, they have measured valued at 15 million, which is the fair value, right? Understanding, right? Fine. We are going to play with this information. Till I draft this balance sheet, again you have time to read this question, right? Balance sheet will come to that later, but for the time being, I will draft this balance sheet. Consolidated balance financial position. I can't use the word balance sheet. Financial position, asset, when you have to prepare asset 30th September 2015. 30th September 2015. You have non-current assets. Assets you have, under that non-current assets you have, then you have current assets. So altogether you have balance sheet, asset side, and equity and liabilities. Equity and liabilities. Under that you have equity, and non-controlling interest format. I am formatting my balance sheet, right? Right. Non-controlling interest. Then you will have total equity. And you have non-current liabilities. In this case, do we have non-current liabilities? Yes, we have non-current liabilities. And finally, current liabilities. So at the end, you have what? Balance. Right, fine. So this is the format. With that, I am going to read the information with you. Right. On 1st October 2014, P acquired 80% of S. Right. P acquired S. Right. P acquired S when 1st October 2014. Right. Step by step, very important. Right. On this day, when 1st October 2014, acquisition date. What is the percentage of acquisition? 80%. 80%. Summary. Right? May visual with very simple for you to understand. 80%. What they are talking about that further? At this date, the retained earning of streamer company were 34 millions and revaluation surplus stood at 4 million. On the same date, retained earning and revaluation reserve. How much? 34 million and 4 million. 34 million and 4 million. We will prepare balance sheet in thousands, right? Thousands. Here understand, this date is much more important. Much more important. Why? You have to calculate, right, post acquisition reserves and pre acquisition reserves for the purpose of calculating goodwill and to share post acquisition reserves between parent and the minority interest. Therefore, first of all, before you prepare this consolidation financial statements, understand the date of acquisition, much more important, right? Make a note there, wherever, right? Keep this in your mind. This date you should understand somehow in the question, right? On the same day, right? On the same day, you have to understand, you have to identify net assets or whatever the given information in the question. Very simple. I am not reading this again in the question. I have visualized it, summarize it. Then read further. Party company paid initial cash amount of rupees 92 million and agreed to pay owners of streamer company further 28 million on 1st October 2016, right? So they have paid 92 million purchase consideration cash, 92 million paid, and they have agreed to pay another 28 million on 1st October 2016, and somewhere here they will pay another 28 million. They will pay another 28. Where? When it's come to 1st October 2016. 1st October 2016. They will pay another 28 million. Right? Anagati thav 20 million given out. The accountant has recorded in the book recorded the full amount of both elements in the consolidated investment. So accountant has recorded both 92 and 28 million together in where? Parents balance sheet, right? In the parents balance sheet, and the appropriate discount rate is 0.857. They have given discount factor also 0.857, right? Fine. Those are the information they have given in the question. Now we have to use these informations. We are using this information available for us. We have to start our calculations, right? Fine. I'll start to draft cost of control account, COC, cost of control account. At the same time, I recommend you to have minority interest as well, which is non-controlling interest, right? I'm always telling what? Minority interest. Why? I have learned these things under that concept, right? That's why, right? But it should be what? Non-controlling interest, right? Fine. Those two accounts. And take your investment from the balance sheet of parents, that is debit balance, credit investment in your parents and debit cost of control account, investment. How much? 92 million. 92 million investment. Double entry what? Logically understand, you have taken investment from parent, credit it and debit to where? In your cost of control account. So therefore you can report it. Investment you have under non-current asset, investment, investment, you have in your balance sheet how much? In your balance sheet you can see investment in parent 120, credit it how much? 92. Credit means I am taking it right from there. 92. Account I don't have space, right? This is a debit balance, no? Credit it means minus it. Credit investment 92 million and debit cost of control account. Cost of control account. Clear? Fine. Understand this. You have paid cash 92 million on this date to acquire S, 80% of X. Now, this cash consideration, purchase consideration, you will pay the market price, right? This is a market based valuation, right? Let's say when you purchase a land today, you will pay for that land today's price. Let's say 5 years ago, whatever the land was close to highway, valued let's say less than 50,000. After 5 years, now almost 5 times of it or 10 times of it. Therefore, you have to pay today's price when you purchase a land. So, you can't say last 5 years because of this highway the price has increased by 10 times. Early it was 50,000 or 40,000, therefore, I will pay only 40,000. No, you can't do it. You have to pay the current market price to acquire. Here also, you have paid definitely, no doubt, the current market price to acquire 80% of S. Current market price, purchase consideration reflect the current value, right? Current market price, which means this is at fair value. Understand it. 92 million means fair value. This 92 million fair value, right? Examiner has not explained this. Make a fair value කියලා තියෙනවද නැහැ. You have to understand it. When you purchase whatever the goods or service, you have to pay the current market price, arm's length price. So here obviously what? Market price. Since you have purchase consideration at market price, other all elements you put into this cost of control account also should be at what? Market price, fair value basically. If purchase consideration at fair value, all other items also you have to consider at fair value. Understand the logic. Make a fair value එකට තියෙද්දි අනිත් ඒවා historical value එකට තියාන goodwill හදන්න පුළුවන්ද? No, you can't do it. Therefore, take the fair value of others as well, right? Fair value. Understand that first, right? Fine. With that, we'll put other informations as well, right? Fine. Now, second thing, you have deferred consideration. So 28 million. Now accountant has recorded this 28 million as it is. 28 million as it is. Now can you include 28 million as it is in your balance sheet? No, you can't. Why? This is a deferred consideration. You have not paid. You are going to pay this somewhere here, right? So you prepare consolidated financial statement 30th September 2015, right? On this date you prepare consol financial statements. On this date you prepare consolidated financial statement. Therefore, you have to discount this to this date. You have to discount this to this date. That is the fair value calculation. What? Present value of future cash flows. SLFRS 13 knowledge now we have to use, right? Future consideration, you are going to pay this in future, discount it and take the present value of future cash flows. Present value of this future cash flow, you have to use this discount factor and take it. 28 million into 0.857. 28 into 0.857. So which is 23,996. 23,996. 23,996, right? Deferred consideration. 23 investment deferred consideration 23,996, right? Deferred consideration, right? So balance part we'll consider later, don't worry. Here, right? So you have to remove how much? 20,000 also from this, 28,000. 28,000, right? So now your investment 120,000 minus 92,000 minus 28,000, 0, right? So second part of consolidation procedure, right? Eliminate or set off carrying amount of investors, carrying amount of the investment made in subsidiary. We have done this. Second step of what? Consolidation procedure. Standard explain you, right? Fine. Then use the balance information, right? Balance. Read it further. Right. Roman number 2. On 1st October 2014, fair value of streamer assets, net assets were equal their carrying amount with the exception of some inventories which had cost 3 million but the fair value 3.6 million. Inventories cost 3 million, fair value 3.6 million, difference 6 million, right? So except some of the inventories which had 3 million, alright, fine. On 30th September 2015, 10% of the goods remained in the inventories of streamer limited, right? So out of this 6 million, 10% still remain. Sorry, yeah, out of this we'll take later that part, right? Fine. Read the balance part of this. During the party company sold goods totaling of 8 million to streamer, a gross profit margin 25 million, 25%. At the September 2015, streamer still held 1 million of those goods in inventory. Party company normal margin to other customers 45%. That also we have to use, right? Fine. With this information, we will try to understand pre-acquisition reserves and post-acquisition reserves, right? That's why I read all these Roman numbers to get familiar with those, right? Again, here, once you put this investment, once you eliminate this, investments, right? All so far we have done what? We have eliminated this investor. That's all. Nothing other than that, right? Thereafter I read the relevant adjustments. Now I am going to do that. Right? You have to understand post-acquisition reserves. Therefore, you have to consider reserves on acquisition date, which is 1st October 2014, and you have to compare 30th September 2015 and post-acquisition reserves. Post-acquisition reserves. Post-acquisition reserves, right? Post-acquisition reserves. Here on 14th October 1st October 2014, these assets you had share capital, you have net assets, right? Return earning, and you have revaluation reserves in your balance sheet. Revaluation, and you have adjustment number 2, inventories as well. Inventory revaluation also. Inventory, right? So reserves, if you look at your balance sheet, subsidiaries, right? Or subsidiaries or S company's share capital 60,000. 60,000 on the acquisition date. It has not been changed on the date of 30th September 2015 also 60,000. No change. No post-acquisition reserves. Right? So here to the cost of control account, the purpose of cost of control account is to understand the goodwill. Goodwill means what? The difference between purchase consideration. මේ account එකේ purpose එක තමයි මොකද්ද? Goodwill එක හදාගන්න එක. If there is any or bargaining negative goodwill earlier, now it is not the case, right? Here debit side you have purchase consideration, right? Debit side you have purchase consideration, and by using this money or the funds, how much of net asset acquired from your subsidiary. You have to credit that to cost of control account, right? Here debit side, මොකද pay කරේ. Pay කරලා මොනවද ගත්තේ in the credit side, right? Share capital you have acquired. Share capital, how much? 60,000, 60%. So sorry, 60,000 shares. 60,000. And reserves, you had how much? 30. Reserves 34 million. Return earning 34 million, right? Understand, at the date of acquisition, goodwill you have to calculate your cost of control account, you prepare at the date of acquisition, right? At the date of acquisition. Share capital you had 60,000, return earning 34,000 million, 34 million basically, right? We are talking about from thousands. And you had revaluation of 4 million, right? Revaluation 4 million or 4,000, right? 4,000. Other than this, you have to consider another one. What it is? Adjustment number 2. On 1st October 2014, the fair value also similar, exception of some inventories which had cost but the fair value 3.6 million. Inventory revaluation. On the same day, inventories has increased from 600 to 600. You had 600 here. At the rate of acquisition, we had inventory 600 as well. Why? How do you derive 6,600? I don't have space, therefore I will do here. 3 million worth of inventories has increased to 3.6 million. So then 600 in 1000. Otherwise 0.6 million, right? 0.6 million. We are talking from thousands, therefore this much, right? Fine. So we have done with inventories as well, right? Fine. So same. These are the return. 34 pre-acquisition reserves, 34,000. Revaluation 4,000 and inventory 600. At the date of acquisition, all the reserves I have taken or credited to cost of control account. What is the logic behind that, right? Is share capital of subsidiary debit, credit here. Return earning, debit, credit here. Revaluation reserve, debit, credit here. Inventory, whatever the increase amount, debit there, credit here. Right? We are taking entire reserves at the date of acquisition cost of control account for the purpose of calculating goodwill. Right? Done. Then post acquisition reserves. When you calculate, you have to consider reserves as of 30th September 2015 straight away. Right? Straightforward. Take it from the balance sheet. 6,000 and return earning increased to 36,500. They are in the balance sheet. 36,500 difference 2,500. And revaluation reserves 4,000 remain. There is no change. Balance sheet change inventory. There is adjustment. What is that adjustment? They are talking 10% of the goods remain in the inventories of S company. Out of these, 6% still remains. As of 30th September 2015, 10% of it, which is 60. Right? Therefore, I erase this. 10% of this. 10% of 600, 60. When you deduct 6,600 from 60, which is 540, right? 540 minus. Why? Reduce. Here increased, here reduced. So then this is the post acquisition reserves. 2,500 minus 540. 1,960. 1,960. මං හදාගත්තේ මොකද calculation එක? Post acquisition reserves. අත්පත් කර ගැනීමෙන් පසු reserves. මෙතන අත්පත් කර ගැනීමට පෙර pre. අත්පත් කර ගැනීමෙන් පසු this much. Return earning has increased to this much. Revaluation no change. Share capital no change. Inventory they have reduced. Clear? Post acquisition reserves you have. Pre-acquisition reserves I have transferred to cost of control account for the purpose of calculating goodwill. Post-acquisition reserves also I can divide into two. Make it අයිතිකාරයෝ දෙන්නෙක් ඉන්නවා. 80% to parent, balance 20% to NCI. Right? 960% of 80%, 1,568. 1,568 balance to now balance how much? 392. 392 to non-controlling interest. Keep that calculation with you, right? Share of profit calculation also you have done. Now we have completed adjustment number 1, 2 and 3 we are trying to do right now, right? That is P sold goods to streamer company, gross profit margin 25%, 30th September 2015, streamer sold held 1 million goods. All right, fine. Now during the year, P is selling goods to S. P is selling goods to S. When they sell this, they margin 40. How much? 10%. Gross margin 25%. Gross margin 25%. They have sold 28 million on this date. How much of goods are remain? 1 million. 1 million remained, right? 1 million remained, right? So third adjustment of consolidation procedure is what? Eliminate intercompany balances. Here when you prepare consolidated financial statement, this is unrealized profit, right? Parent sold goods to subsidiary by keeping a margin, right? Margin. If you combine asset and liabilities of P and S, this will be a duplication. Therefore, you have to eliminate the relevant margin from this 1 million, not from 28 million. Why? You have sold this to whom? Outside customers. 27 million out of 28 million you have sold to customers. They have realized the profit. But 1 million still profit is not realized. Therefore, if you combine P and S without eliminating profit related to this 1 million, it will be duplication. Understand? 28 million වලින් 27 relative only ඉවරයි. Unrealized. But 1 million is still not sold to the outside customers. Therefore, 1 million is with 25% intercompany margin. Therefore, that you have to evaluate. 25% of it, which is 2,500. Right? Now, we have done all the adjustment. Now go to your balance sheet and straight away add line by line. Right? Property, plant and equipment. Non-current asset, property, plant and PPE. How much? Straight away I can do 392,000. 392,000 plus 84,000. Right? No revaluation, there is nothing. Add together 392,000 plus 84,000. 476,000. 476,000. Right? 476,000. In your balance sheet, investment 0. All together non-current assets 476,000. Then you have to consider goodwill. Goodwill, all do we have? Right, we haven't calculated right here. Goodwill. Goodwill you can take from where? Cost of control account. Understand this as well, right? Make a තේරුම් ගන්න. But you need to understand here the purpose of this cost of control account calculation is to arrive or to derive goodwill, to derive the goodwill. Goodwill කියලා කියන්නේ, here you have paid this much to acquire this much of assets, right? How much you have paid? How much you have paid? If you consider this, sorry, how much you have paid? 92,000 plus 23,996. 115,996 to achieve this 100% assets, sorry, reserves. මෙතන තියෙන්නේ 80%. This is 100%. Can you match 100% to 80%? No, you can't do it. Understand? එහෙනම් ඔයාට මේකත් 100 කරන්න ඕනේ. මොකද්ද balance එක? Non controlling interest at the date of acquisition. At the date of acquisition. මොකද්ද non controlling interest at the date of acquisition? Examiner has given you the last adjustment. The party group uses fair value model. Right, that is also fair value. It should be fair value model method for assessing non-controlling interest at the acquisition date. Non-controlling interest 15,000. 15,000. So at balance 20 here, then it's become 100. 15,000. So then at 20%, so 100%. Now you can compare. Add this 130,996. 130,996. 130,996. Right? Fine. If you deduct all these things from this, $32,396. 32,396. 396, which is goodwill, right? Credit here, debit here. Goodwill 32,396. You have paid this much to achieve acquire this much of share reserves, means you have paid more. You have paid more means you have paid for what? Goodwill. යාගේ තියෙන හොඳ නමට වැඩිපුර ගාණක් ගෙවලා තියෙනවා. ඒක මොකද්ද? goodwill එක. හොඳ නම goodwill. Right? Let's say you have paid less than the net asset acquired, which means that is not a goodwill. Earlier it was not a negative goodwill, but right now bargaining purchase. Right? Bargaining purchase. If it is in this side, not the goodwill, bargaining purchase. Right? Fine. Goodwill we have done. Right? So then what is next in your balance sheet? Current assets. Current assets 94,700. 94,700. Parent, subsidiary 44,650. I told you in the first step 650. 44,650 minus adding line by line. First step of consolidation procedure. मैं आपको add करना. And you have to deduct what? There was unrealized profit. 1,250,000, right? Yeah. 250, right? Unrealized profit 1,000 into 10%. 1,000 into 10% means 1 million into 10% here. 250. Unrealized profit. That is there in inventory. Unrealized profit. That is not realized. Out of 28 million, 27 realized. Unrealized profit is there 250. Deduct it. 250. And inventory 3 million here 3 million exceeded in 3 million increased to 3.6 million. Therefore, out of 3.6 million, only 60 available as of 30th September. Therefore, plus 60. Understand? Inventory වැඩි වෙලා තියෙනවා 60 වලින්. Right? At those things. 94,700 44,650 minus 250 plus 60. 139, 160. 139, 160. මේ දෙක තේරුණා right? 250 කියලා කියන්නේ unrealized profit 1 million වලින් 125ක් තාම realize වෙලා නැහැ. 60 කියලා කියන්නේ inventory වැඩි වෙලා තියෙනවා 3.6 වලට. හැබැයි අපේ reporting period එක තුල තියෙන කේද 60යි. එහෙනම් inventory වැඩි වෙන්න ඕනේ. Current asset all these things fine done. Now equity and NCI all these things add together. Equity you can't add together. Why? You are taking net asset here of the parent here. How much? 200 share capital. Share capital 190,000. 190,000. Straight away as it is from balance sheet. As it is from the balance sheet. I have taken these things. Then you have retained earning. Retained earning. How much? 210,000 plus you have a share of profit, post acquisition share of profit. Kiya koda aitida 1568 from subsidiary. Subsidiary koda ehema ganna pulanda ba. Line by line වලට add කරන්න පුළුවන් දෙවිද බෑ. මෙතන 100% ගත්තා. return earning කොච්චරද 80% post acquisition 1568 balance 392 you had to put where non NCI share of profit 392 opening balance fair value 15 million. That was there right in the question. That is also considered. And you have to deduct how much? 250. What is that? 250 we derived here when we calculate unrealized profit. Unrealized profit no return in 250. Right? Methaning adu kala methane thadu otherwise it's not a double entry. Current asset වලින් අඩු කරා equity වලින් return වලින් අඩු කරා. Right? How much? Minus 1568 minus 250. 208, 100. You have to add three things now. 210,000 plus 1568 minus 250. 211, 313. 211, 313. And you have to add here revaluation reserves also there. How much? 41,400. 41,400. Revaluation 41,400. So all these things add together and take to the next column. Right? How much? 90 plus 11,318 plus 41,400. 442,718. Right? Fine. Now take, hold on. Now take minority interest or non-controlling interest. Always I am telling minority interest, but that is not the case. Non-controlling interest straight away from this 15,392. 15,392. Right? Total equity. How much total equity? Plus 15,392. For 458,010. 458,110 total equity. Then non-current liabilities. Non-current liabilities, deferred consideration. You have 28,000, but you can't keep 28,000 here. Right? You have to consider only the fair value of it. How much? 23,996. Here 23,996. Right? Deferred consideration. Why? Because present value of future cash flows. And current liabilities you have 100 straight away 137,300 plus 28,100. 50. Right? Add these two together. 137,300 plus 28,110. 165,450. 165,450 plus 23,996 plus 458, 110. Balance sheet should tally 647,556. 647,556. Asset side 476 plus 32,396 plus 139, 160, 400, 647, 556. Done. So balance sheet is tally. Right? Fine. So this is the simple question or calculation over consolidated financial statement. I told you this is not a comprehensive question. Very simple question, but much more important to understand this logic. මේවා තමයි important. This acquisition detail you should be able to visualize. So then it is very easy for you to handle few further balance part of the question. And cost of control account, the purpose of it is to calculate goodwill, all the information as of acquisition date at fair value. Why? Your purchase consideration at fair value. That's why deferred consideration also discounted and entered here. NCI also at fair value 50 you have to record. Why? Because all these elements they are in cost of control account fair value. And you have to calculate first of acquisition reserves. First acquisition reserves means the difference between reserves from the date at the date of acquisition and the reporting date. And you have to divide into 2 and do this. And if there is any eliminated or unrealized profit, that you have to remove. That's all. 3 steps now. Add line by line and use eliminate or set of investments. Second steps. Third step of consolidation process is eliminate intercompany balances, which is 250. මේ තුන තමයි මම කරලා තියෙන්නේ. මේ තුන කරනකොට මම කතා කරලා තියෙනවා goodwill එක ගැන, NCI ගැන. That's all. And the post acquisition reserves. Right? This is not a magic. So simple logic you can apply for other questions as well. Right? Understand it. Fine. With that we have done SLFRS 10 with a calculation, right? With to explain the consolidation procedure. Right? Fine. So the last standard I am trying to discuss with you, not in detail, but for you to give some understanding, right? Take LKS 28 under group accounting. This standard also much more important, right? Fine. Suraj, better if you can take the screen. Right. After SLFRS 10, I wanted to touch it. Take you through LKS 28 also. Why? Because this is applicable for investment in associate as well as joint venture. Joint venture standard already we have gone through, and accounting treatment also we have discussed. But associate standard I haven't take you through the standard. The intention right now is to explain the important areas of this. Right? Fine. Okay. This is not a big difficult standard to understand. Right? This is the last standard I want to discuss with you relating to group accounting. Right? So I have highlighted important things for you. I will read it for you and explain the importance of it. Right? Fine. Okay. If you look at this, right? If you look at this PPT slide, red color you can see joint associate. Right, associate companies. If you don't have control alone, yes, you have to check whether you have control jointly. No, whether you can put significant influence. Yes, you can put significant influence. If so, you prepare what? Accounts by applying IAS 28. Why? You have significant influence, right? Yes. So if you have significant influence through joint venture or associate, you apply equity method to prepare financial statement, not the consolidation method, equity method. That will explain through this red color journal. Right? Just wanted to show this slide. I have already shown that slide to you. So here, what is very important word? Significant influence. So associate company means you have significant influence. What do you mean by significant influence? Paragraph 5 you can highlight. because for this standard I am not trying to summarize with the limited time, I am trying to only explain the important elements of the standard, right. If an entity holds direct or indirect 20% or more voting power of the investee, underline the word 20% or more of the voting power of the investee, it is presumed that entity has significant influence, unless it can be clearly demonstrated that is not the case, right. If not the case, you have to prove it. If not, if you have more than 20%, you have what? Significant influence. Conversely, if the entity holds directly or indirectly less than 20% of voting power of the investee, it's presumed that entity does not have significant influence unless such influence can be clearly demonstrated. You can consider for associate or equity method of accounting for the standard even with the less than 20%, but if you have less than 20%, you have to prove it unless influence is directly demonstrated. You have to demonstrate it. If you can't demonstrate with less than 20% stakeholding for voting shares or with voting rights, you can't apply this standard, right. For you to apply the standard, you should have more than 20%. If it is less than 20%, you have to prove it, right. Otherwise, you can't apply the standard. Significant influence means that you can't say you have significant influence. If so, the existence of significant influence by an entity is usually evidence in one or more of the following ways. Representation of the board of directors. If you are representing board, you can have a significant influence. Participation in policy making processes. So when you prepare policies, group policies for the company, if you are participating for that, you have what? Significant influence. Material transaction between entity and investee. You are involved in for material transaction between entity and investee. If so, you have significant influence, right? Material transaction between investor and entity and the investee. Interchange. Let's say you have purchased 20% shares of another company, and you have material transaction between entity and the associate company. So then you have significant influence. Interchange managerial personnel. Let's say your CFO is looking after associate company's financial statement as well. So management, you can interchange between two entities. So then you have significant influence. Provision of essential technical information. So then if you are satisfied with these conditions, you have significant influence. Don't try to remember. Paragraph 6. Have I come satisfied with no? In one or more of the following ways. If you have one condition, if you are satisfied, you have significant influence. Don't misunderstand. All these conditions should not be satisfied to identify them as significant associate companies. Only one condition more than enough. Right? Fine. Significant influence. මේවා තියෙනවා නම් apply කරන්න in case 28 accounting for joint venture and associate. Right? Fine. Equity method of accounting. Right? For joint venture and associate companies. Right? For joint ventures and associate companies, not for joint operations. Joint venture, joint arrangement has two things, no? Joint operation and joint venture. For joint venture and for associate companies, you apply equity method of accounting, right? Not the line by line consolidation. Only you have rights to what? Share of profit of the associate company or the joint venture, right? Under equity method, on initial recognition of investment in an associate or joint venture is recognized as cost. Initially you recognize at cost, and carrying amount is increased or decreased to recognize the investor's share of profit or loss of the investee after the date of acquisition. Subsequently, at the end of each reporting period, you take what? Share of profit of loss of the investee after the date of acquisition. Share of profit you have to consider, right? Fine. Distribution received from investee reduce the carrying amount of investment. If you are receiving distributions, dividends, carrying amount will be reduced, right? Fine. Equity method of accounting is that. Right. Application of equity method. Exemption from applying equity method. මේවට ඔය apply කරන්න equity method එක. Very important. Paragraph 17. And entity need not apply equity method to its investment in associate or joint venture if the entity's parent has that exempt from the preparing consolidated financial statement by scope exception in the paragraph 4 SLFRS 10. Very important word. I will simplify it for you. Let's say there are 3 entities. A, so blue limited, red limited and black limited, right? Let's say red has acquired 25% of black. Red has acquired 25% of black. So then significant influence. Red can put significant influence on black. So red should prepare what? Financial statement by considering according to equity method of accounting. Now let's say blue. Blue acquired 80% of red and blue prepare consolidated financial statement. If you prepare consolidated financial statements, he is the parent, blue is the parent. Now red no need to prepare financial statement by applying equity method of accounting. Right? So red apply equity method of accounting, not blue. Why? Ultimate parent is red. Similar to subsidiary. Let's say blue acquired 80% and B control A, and red is the ultimate parent because 100% ownership of blue. So red prepare consolidated financial statement, not blue. Here you will not apply equity method of accounting in that case. Only red ultimate parent prepare consolidated financial statement. Understand it. Very simple. Right? Paragraph 17. Then classification as held for sale. Entity shall apply SLFRS 5, which we haven't discussed. An investment or portion of an investment in an associate or joint venture that meet the criteria to be classified as held for sale means its sale is mostly probable, right? Any retained portion of investment in an associate or joint venture that has not been classified as held for sale shall account for use in equity method until disposed, right? Let's say once you decide to sell, dispose an investee, from that date onwards you have to identify as what? Asset held for sale and discontinue operation. But let's say part of it you are not recognized under that, so then for that part you have to continue to apply this standard, right? Discontinuing use of equity method. Quickly I am taking you through only the paragraph. You can read at home later, right? Highlighted everything here there. Only important things I am explaining. And until discontinue use of equity method. Equity method is discontinue karna from the date when its investment cease to be an associate or joint venture. If it is from you will de-recognize or discontinue from associate or joint venture from in these scenarios. If the investments become a subsidiary, right? Now let's say 2 entities. Till today you have significant influence, but tomorrow onwards you have a controlling power over black. So then you have to prepare consolidated financial statement. It is a subsidiary, then you have to apply SLFRS 10, not LKS 28. If retained interest of the former associate or joint venture is a financial asset, the entity shall measure retained interest at fair value. So this is important for me to discontinue equity method, right? මොකද්ද වෙන්නේ? associate එකක් subsidiary එකක් වෙනවා නම් equity method එක discontinue වෙනවා. Then paragraph 24. If an investment in an associate becomes investment in joint venture or investment in joint venture become investment in associate, the entity continue to apply equity method does not remeasure the retained interest. Very simple. Let's say associate become joint venture or joint venture become to an associate. Both way possible, no? So far red is associate of black. From tomorrow onwards red is a subsidiary of black. Not subsidiary, joint venture. Associate converted into joint venture converted into a associate. Both way you apply equity method for both, therefore no change in the accounting treatment. Only share of profit you will take, associate or joint venture. Finally, right, how can we apply? So what is important for me in this standard? 3 things, right? 2 things. What are they? See, what do you mean by significant influence and accounting treatment? Significant influence I explain you, accounting treatment, equity method I explain you. I'll take simple example to explain this further, so then you can understand very easily, right? With a double entry. Look at this. Equity method, the equity methods, right? Under equity method there is a calculation. So I will show that calculation finally. So based on that you can right. Look at, read this question. Very simple question. On January 2003, Pacific Plant Group acquired 25% of Atlantic Aquatic Company, associate company, right? Significant influence, more than 25%. To the cost of 150 million, cost 150 million. Atlantic Aquatics made profit in the year ended 31st December 2013, 30 million. And no other comprehensive income. On July 2013, after 6 months from the date of acquisition, Atlantic Aquatic declared interim dividend of 5 million interim dividend. Right? Now we have to consider equity method of accounting here. Right? Fine. මොකද අපිට ඕනේ investments එක තියෙනවා 25%. කොච්චරද cost එක 150 million and December එනකොට profit comprehensive income 30 million profit එකක් තියෙනවා, right? Profit made and 5 million dividend, right? Fine. Now I'll show you the calculations, right? Fine. Now take this double T accounts. Equity method accounting මම මේ කියලා දෙන්න, right? Right? Equity method accounting. You have 2 accounts. Hope you have the data. You have gone through this question, right? I can't show both screen and the calculations, that's why I am using only the board, right? You can go back to the video and see the numbers, right? 3 accounts we required. Investment in associate, and cash, and you have dividend account, sorry, interest investment income, which is dividend income, and you have finally profit and loss account. Profit and loss account, right? Very simple, 1 minute more than enough to handle this example, right? Fine. How much the investment? 1st January 2013, Pacific or P, let's say P Plant Group acquired 25% of Atlantic Company at a cost of 150 million. Cash payment. You have paid cash, credit 150 million, and investment in associate cash, how much? 150 million. Simple double entry, right? Investment in associate. Thereafter, you have received dividends, how much? 5 million dividends they have declared. 5 million dividends they have declared. Out of 5 million, your portion how much? 25% stake you have acquired. Question clearly explain you. Right? 25% you have acquired from Atlantic. So then 5 point means 1/4 of it, 1.25. Right? So investment income credit, dividends 1.25, and you are received in cash, right? Dividend cash. cash 1.25 million, right? Fine. Now finally you have profit. They have declared 30, they have reported 30 million profit, 30 million profit, 25%, 30 million into 25, 7.5, 7.5. How do you report 7.5? Your share of profit in your P&L, share of equity method, no? Right? Only share of profit you are taking, not the line by line consolidation. 7.5 million. Your investment in associate, share of profit. Here you have to be mindful. Out of 7.5 million, we have already taken 1.25 million as dividend. So then, in your investment, 7.5 minus 1.25, which is 6.25, you have to consider in your balance sheet, right? So, and you debit yeah 6.25, right? And now you have credit 7.5, debit here 6.25, investment income also you have to debit, share of profit 1.25, investment income will be over. Why? Because already you have taken share of profit 7.5 million. Investment income එක මෙතන තිබ්බොත් double වෙනවා. එහෙනම් මේක එයින් කළා. You have received in cash. That is there in the cash. Right? Fine. Over. Right? Double entry is dividend 1.25, share of it 6.25 out of dividend, dividend also out of share of profit 7.5. So this is the simple equity method accounting, right? In your balance sheet, how much? 156.25 you have to show as what? Investment in subsidiary, right? Sorry, investment in associate. Investment in associate can make a, you have to every year you have to add share of profit to the relevant investment. So next year profit you will add to this share of profit only, right? That is equity method of accounting. Very simple calculations, right? Fine. Oh, that is the quick discussion on LKS 28. With that, from the conceptual framework, we have discussed many accounting standards. I will take another 3 minutes to summarize the entire story. I told you before you start, even read the question in the exam paper, you have to do some homeworks. What are the homeworks? Take your past papers and turn to last page of that past paper and read the action verbs, right? Understand the definition of action verb. Why you can't talk to your examiner, but you have to show your interpretation skills to your examiner. When you interpret your skills, you have to address the keyword action verbs there in the question paper. That is first advice. Second thing, take few examiners comment, download it from CS site, right? Go to website and download examiners comment, what they have observed from the students, right? Your weaknesses as highlighted by examiner. So then you can see where they went wrong. If you are repeating this subject for a longer period, where you have went wrong, you can understand from that activity. Then 4 golden rules you have to apply within this learning curve. What are they? Conceptualize everything. I have done that for selected standards, and insert paragraph for that and examples, and write exam questions. Don't read exam answers and the question, write it, then you will improve your confidence. I told you very first day, if you don't have that self-confidence, don't go and sit for the exam, right? Assess your confidence level day by day. If you are increasing, yes, it's a positive thing. If you are decreasing, it's not a negative thing. It's a negative thing. Therefore, before go to the exam, if you don't have confidence, I told you, better to watch a film at home rather than wasting 3 hours at the exam. That is my final advice, right? Try to improve your confidence level and don't think it as, very difficult paper, right? It's not a difficult paper. Why? It's an open book exam. Don't try to remember things in your mind. Try to understand the logic behind each and every equation and use the application from this, take the applications from the standard and take some paragraph from the standard book when you start writing and show your interpretation skills to the examiner, right? That is the whole advice that I can share with you, right? All the best for the upcoming exam. Thank you.